If you're just starting out in trading, it's easy to feel overwhelmed by indicators, signals, and strategies. I've been there, but here's what no one tells you. Some of the most powerful patterns are the simplest, and they have been working for decades. In this video, I will show you 3 timeless chart patterns that every beginner should know. And the best part, you don't need a single indicator, just price action. Let's dive right in. Hi everyone, I'm Kojak's Pro with over 3.5 years of experience at trading. When I first started trading, I tried everything: RSI, MACD, Bollinger Bands. It felt like a science project. But the more I traded, the more I realized the charts already tell a story if you know what you're looking for. These 3 patterns helped me stop forcing trades and start trading what the market was actually showing me. Number 1 is the double top. So in double tops, price ascends to a particular level and then pulls back. Now, after the pullback, there is a reattempt of the same level, but this time around, that level holds price such that it's even on the 2 tops, and then price now shoots back to the downside. So a double top basically causes price to reverse to the downside after stops have been made. So to exemplify this, so this is when price shoots up like this and then pulls back. And instead of price making a higher high to continue bullish trend, price comes back to the same level and holds there. Just take this out. So I'm just going to run through that quickly. Price moves here, pulls back, comes back to the same level, holds there, and then pulls back down. Then we have price plummeting to the downside, like so. As simple as that, that's what a double top is. And one thing you should know about double tops is that your cue to know that there is some sort of bullish exhaustion is at the second top. Once you get to the second top and you see that price has failed to break above this area right here, that is how you know that there is an imminent reversal of price. But you don't get in at the second top. As a matter of fact, that's the very wrongest area to get in to get into the trade. You should only try to wait for a certain kind of confirmation or criteria to be met, which is the neckline. You see this particular area right here. So every chart pattern has got a neckline. So this is the double top with these 2 tops, first top and second top. Now this is the neckline, this entire area, which is kind of the middle of the chart pattern. So once price breaks below this area, you can get into the trade. Your stop loss can come above the tops. It's as easy as that. Now I'm going to simplify the next chart pattern, which is the double bottom. Now a double bottom is simply the reverse of a double top, and in a double bottom case, price has been coming down for a while, sort of like a downtrend, and it gets to a certain level where price hits support area, pulls back. Now in order to continue the characteristics of that downtrend, price should break this area. But instead, price comes to stop back at that same area and then begins to pull back. Now, this has now showed, if I just put this right here. So this area right here, this second bottom right here has just showed that there is bearish exhaustion and the sellers are about being done, and the bullish markets or the bullish traders are gaining more and more momentum. So once this happens, you should be thinking of a reversal trade. Now in this case, how do you get into this trade? Simple, it's still like the first one. You have to wait for this neckline to be taken off. So once the neckline is taken off, like so, you get into the trade. Your stop loss comes below here. Assuming this is the kind of trade you're talking about. Your stop loss comes below here, and then you can set like just put this right here. Then you can set like a 1:2 or 1:3 risk to reward, depending on where you're going. So that's how you trade double tops and double bottom. Now the last chart pattern, which I'll just quickly do in this session now, is the head and shoulder pattern. Now in the head and shoulder pattern, it's one of the most prominent and choicest indicator for a trend reversal. So head and shoulder pattern reverses trends. Now, what happens actually in the head and shoulder pattern is that price gets to a certain point, maybe in a bullish trend, pulls back, and then it still makes a higher high. So the trend still continues, it looks like so for now. And price pulls back. Now,
price pulls back to, instead of price to pull back at least to the same area where it can continue an upward trend, which makes it like price should pull back to a higher low. So in this case, price should have stopped here, but instead you see price pulling back down to the same low it had created initially. Then we are now expecting price to continue this bullish trend, but price doesn't. It doesn't continue this trend. Rather, it stops midway and then begins to pull back down. Now, once it pulls back down, something remarkable has happened here. It has beat, price has beat the characteristic of an uptrend. Now, the characteristic of uptrend means that price were making higher highs and higher lows. But in this case, you can see right here, like the last high that was made was lower than the previous high. So the trend has immediately changed to a range pattern, a range bound, trade, a range bound market. Now, once this happens, it's created what is known as the head and shoulder pattern. Now, this is the head, this is the left shoulder right here. So we've got the left shoulder right here, then we've got the head right here, and then we've got the right shoulder right here. So that's why it's called head and shoulder pattern. Now, it's got the same neckline like the previous two chart patterns, the double top and double bottom. Now, this is the neckline right here. How do you get into this trade? You should only wait. As for head and shoulder patterns, you should only wait until the neckline is taken off. Once the neckline is taken off, you can get into this trade. So like so, we'll wait for something like this, and price pulls back here. Then we can now ride the trade to the downside. So typically, where will your stop loss come in this kind of trades? So it depends. It depends. Some people actually want to wait for the break of the neckline and wait for a pullback, and then that will be their entry position. Like so, some people can enter on the break. In this case, some people can enter on the break here. So I'll just put this out. So some people can enter the break here and then put their stop loss just above the right shoulder, and then aim for maybe 1:2 or 1:3, as the case may be. While some others, somewhat conservative, will wait for a total break, wait for a retest rather of the neckline. So in this case, once price comes to retest the neckline and holds there, you see them getting right about here, and then their stop loss just comes just above the neckline, and then they ride the trade to the downside. The second one gives a better risk to reward, in which case you can make more money on the second one than the first one, because the first one makes your stop loss to be wider, and you having wider stop loss puts you at more risk of market dynamics, because you'll be tempted to take profits to a region where price might not likely get to at that point in time. So all this comes with experience, so I'm just pointing it out now. So that's it about the head and shoulder patterns.
So let's recap. Double top is for reversal down from resistance. Double bottom is for a reversal up from support. Now, head and shoulders is for a trend shift from bullish to bearish. These patterns aren't magic, but they are powerful when combined with patience and confirmation. Most beginners look for the perfect indicator, but the real gold in trading comes from understanding price behavior, which is also known as price action. Double tops, double bottoms, head and shoulders. These patterns have been around forever because they reflect human psychology, like fear, greed, hesitation, playing out on the chart. If you're interested in learning how to combine these patterns with structure and proper risk management, type 1 in the comment below. And if you haven't yet, grab my free trading ebook. It's linked below. It breaks down 6 common mistakes traders make and how to avoid them. And don't forget to like, subscribe, and I'll see you in the next video.